Happy Tuesday, everyone. Rich Swerbinski with the Mortgage Collaborative here once again with the last week in Mortgage Today, where we run through the week that was in the mortgage industry. And each week I select one of our lender members to be my co-host. And this week, really happy to have in the co-pilot seat, the Senior Vice President of Over Mortgage Lending for American Federal Mortgage Corp, Andrew McElroy. Andrew, great to see you.
Thanks, Rich. Thanks for having me.
Yeah, really appreciate you joining us. And let's get into it as usual. No shortage of things to discuss in our industry. And let's start with what has been the prevailing theme of the year: economic news, inflation, interest rates, all which have provided various levels of headwind to housing and the mortgage industry throughout the year. And got a bunch of data last week. We got the CPI, the kind of main inflation number data on Wednesday, a little bit hotter than expected. And then we got the producer price index Thursday. And then on Friday, we got a pretty significantly stronger than expected retail sales number and a more promising than expected University of Michigan consumer sentiment index. So some positive signs for the economy heading into the weekend after a scary inflation number early in the week. Through it all, mortgage bonds and mortgage rates have kind of held in there. We're just kind of bouncing around the mid fives right now, a 30-year fixed, correct?
Yeah, it's been staying pretty steady. I mean, a little move up, a little move down, and that's, I know our secondary people, in conversations with them, I think that's kind of what we're hoping is, that they kind of at least stay steady. That quick move upward was, a little bit, I think, a shock to everybody. And, people trying to, buy houses, trying to figure out what to do, when they see those moves that rapidly. It's, I think, a little bit intimidating, a little scary for them as far as, venturing into that process of starting to look for a house and finding somewhere to live.
Buying a house alone is a scary proposition, especially, in this market where values have run up 20-30% over the course of the last couple of years. Then all this news that prospective home buyers are reading just about interest rates flying up and shooting up at record levels and bouncing up, bouncing down. You're right. It really, I think, just for a lot of people, tired buyers was the term somebody used that I thought was pretty good. But now it seems like rates are stabilizing. It seems like the economic news, there's just as much positive and bullish as there is inflation bearish or negative. And it feels like things are starting to settle in a little bit as it relates to just purchase activity.
It does. And I think, in hearing and, what you see on TV and here is that, now the supply might be starting to loosen up slightly, that there's, maybe some more houses on the market. I'm not sure. I'm sure it's, regional, in different areas, it's differently. I don't think there's been a lot of price, decreases or, where values are starting to go down. But I think that there's more supply maybe for people to be able to shop and maybe find someplace rather than it was, 6-8 months ago where or a year ago where the supply was really, really limited. And, I think, I think you're right. Buyers are tired. They can't find a place to live. They see every month that the cost of the house that they maybe want to buy is going up, $200, $300, $400, a month because rates are continuing to move up and the values are continuing to move up. So hopefully it has kind of stabilized and where, people can get their footing under them a little bit and be able to, get comfortable and get their hands around, what it's going to cost and what they're looking to buy.
This is the last week in Mortgage Today. I'm Rich Swerbinski with the Mortgage Collaborative. This week joined by American Federal Mortgage Corp's SVP, Andrew McElroy. And Andrew, if you could just level set a little with the audience, tell us a little bit about American Federal.
Sure. American Federal's direct-to-consumer lender. We're in 14 states. Our CEO, it's kind of, it's a story I think probably a lot of people have, but our CEO, Mark Young, started the company in his basement 35 years ago and, basically has, grown it, grown it to being we're not huge, but we're, substantial, non-bank lender and, and covering, pretty much the East Coast. I've been with him 25 years, so, and done a lot of different things, for the company during that time. So, so yeah, I mean, it's, we try to do business the right way. It's really all about the consumer. And been a good career for me, working there. So it's a good company, and, good people, and, just trying to help people get into homes, and, and kind of realize their American dream of getting into a house. So.
Good stuff. Yeah, thanks for running through that, Andrew. And thanks for sharing a little bit about American Federal. Very cool story, a similar one to many TMC members. Love to see companies like that, just started by one, two, a few people that have grown slowly over the course of time and been able to exist through many, many different kinds of cycles in our up and down industry. So excellent. Moving on with the news, FHFA, Federal Housing Finance Association, that oversees Fannie Mae and Freddie Mac, in the news a few different times this week for various different things. Probably the most headline worthy was just some Republican congressmen that called for a little bit more oversight of Fannie and Freddie. Kind of citing that the charter calls for more oversight than there is right now, and expressing some concern, not directly mentioning 07, 08 and the meltdown, but just product development for Fannie and Freddie. The Biden housing supply plan that they put out a few months ago, a lot of different stuff in there. If it's manufactured housing, ADU, all this, a lot of different types of things. And I think the Republican lawmakers just kind of saying, like, let's just, I'm not saying this is a bad thing, but let's see what's going on here, because we saw what the implications could be if government, is needed to help out the housing market. So any thoughts on that news, FHFA, this week?
Yeah, I mean, I understand the sentiment that they're holding, but I think that, on one hand, I mean, totally, when you have, the agencies in conservatorship, and, the taxpayer being on the hook for those agencies in the event that they have large scale defaults and need infusions of capital. But I think it's probably a little bit different now than it was in 2002 and 3 and 4. And, Fannie Mae and Freddie Mac were doing, you probably remember, expanded approvals and, lower credit scores. And, the credit book over the last, certainly 5 or plus years is as strong as it's been in, in probably my 25 years doing this. So I think if the economy goes into recession, obviously during recession, you have job losses and things like that. There's going to be, there's going to be defaults. That's the way, unfortunately, in kind of this industry, that's the way it goes a little bit. But I think that the strength of the book is a lot stronger than it was 10 years ago, 15 years ago. And, hopefully strong enough to be able to sustain, any downturns that'll happen.
The amount of equity people have, you're right. We've got delinquencies at pretty much all-time lows as it relates to people paying their mortgage. Labor market is strong.
Very strong, right?
Change, obviously. But, I think that having, I had a chance to speak with Sandra Thompson a few times. She's very cognizant of the safety and soundness part of what FHFA is doing. Still, good to have oversight.
Yeah.
Many have argued the CFPB has no oversight, and that's been penal in a lot of ways. So, anytime government is getting involved in major things, and housing, certainly major housing finance,
Absolutely.
want to
part of the economy.
So, so I think you'll probably see a little bit more of that, especially as we go into an election.
And I think it makes sense for them to raise the issue as, if there is concern that the economy might be going in the wrong direction. And of course, when volumes shrink, in general in our industry, the box maybe expands a little bit as to the loans we're, trying to do just to help supplement some of that volume. So I don't think it's a completely unreasonable thought process for them to have, a little bit of concern about that.
Absolutely. FHFA also in the news today, a couple other times, kind of comments that were made. One about the commingled security fee. that is charged when loans are Fannie and Freddie loans are placed in the same securities together. A lot of lenders knowingly paying this 50 basis point fee, others unknowingly. And then FHFA Sandra Thompson also coming out and saying that they're creating within FHFA an office of fintech.
Mhm.
So I think a lot of us in the mortgage industry kind of joke about the word fintech at times because there's so many fintech lenders that have come and gone. Some are great; they're still here, but her statement in and around this office of fintech was that it will help advance effective risk management as FHFA evaluates applications of fintech in housing finance. And I think what's going on here, and welcome your thoughts, is just there's a lot of data that's available to the federal government as they are running big chunks of housing finance, if it's HMDA data or automated underwriting engines, and just ways that tech is getting involved with consumer decisions in a lot of different ways. And I think there's just some level of uncomfortability and with all that and how quickly it's happening, and also wanting to make sense of that data. So it looks like some additional resources along those lines coming down the pike for FHFA.
I think some of it too, Rich, is the technology for, because it's rapidly changing. Now you have tools that are doing income calculations, looking at assets, essentially making credit decisions, without a human touch. And I think part of the concern, from regulators and probably from the agencies is kind of getting under the hood to understand what exactly goes into those decisions, and looking for potential biases or potential, probably fair lending and things like that are there that could, somehow adversely impact certain borrowers or certain classes, to make sure that, that they're applied fairly.
Yeah, absolutely. I mean, if you're a regulator of our industry, and this administration clearly and rightfully very focused on lowering the bridge to home ownership and the racial home ownership gap, you don't want mortgage lenders to be able to say, well, I just I did what the underwriting engine told me, when you don't know what the underwriting, there's LP and there's DU, and those are controlled by the government and Big Brother and all that. But there's a lot of third parties that are coming out with automated underwriting tools now.
And it's so rapidly changing. That's the thing that, is, I talk about all the time with our staff and with, other people, is that, you used to change how you would maybe underwrite a loan or how you would process a loan once every 5 years or so. Now it seems like if you are not in a constant state of reevaluation, you're at the potential of falling behind, and that the tools that are there for, scaling the business and for, the customer experience, trying to get, the customer in, today's age to be able to, move their application as quickly as possible. They're just ever changing. And I think, sometimes when they change, there's that rapid of a change and there's that much change, I think it can be a little bit, scary for a lot of people, for business owners, for, people that are trying to run an operation. And I'm sure for regulators, who are trying to make sure that, they're applied in a way that is fair and, fair to the, to the public. So.
Very well said. This is the last week of Mortgage Today. Rich Swerbinski this week, joined by Andrew McElroy of American Federal Mortgage Corp. Andrew, the Freddie Mac came out with a study that just recently, it was the first of a 3-part study on home buyer migration. Very, very interesting. You forwarded this to me as we were going back and forth. I had not seen it yet and spent some time pouring through it this morning. Really, really interesting. And what it done, I would suggest anybody listening, Google it, you'll find it. Maybe somebody on our team can link it in the chat, but it looks at trends for 2 years, like Feb 00, I think to March 02. And specifically looking at trends related to migrations of humans and housing across America. A lot of stuff in there. One thing that really caught my eye was the list of like the top 20 metro regions that lost population, and those that gained population, starting with the metro areas that lost population in the last 2 years. 1, 2, 3, 4, 5, New York, LA, San Fran, DC, San Jose, Santa Clara region, the top 5. And then you look at where you look at the other side of the ledger where everybody's moving. The top 10 just littered with Florida, Arizona, Texas, more affordable parts of those states. A lot of Connecticut in there too, which kind of caught me off guard. But your thoughts on the first of this 3-part series that Freddie put out?
Well, I think it's the chase for affordability. I think that maybe the pandemic now has allowed people, our company, and I live in the New York metro area. So I see it firsthand. They're high cost areas. It's expensive to live in, a place like New Jersey or a place like Pennsylvania or a place like New York. I think that now people have the ability to be able to move to places, outside of their metro area, maybe, where a 2-hour commute would have been impossible 2 years ago or 3 years ago when they were working in the office every day. Now, if they're going in once a week, for the amount they can save to maybe move, 2.5, 3 hours away from their metro area, it might be worth it for them to do it because it's considerably more affordable. And I think, some people that aren't working in the office at all, can move across the country to areas that are a lot more affordable. So it'll be interesting if the trend holds, if, the work from home holds and those type of things hold, or, if there's a drawback toward the metro areas. But I think, it kind of makes some sense as to how that's taken place. And, and people, trying to go where they can, live in a good area and also not pay a fortune to live.
Great points. And you look at last Friday's retail sales number being strong, essentially consumers are spending more money in the face of raging inflation than any economist is projecting. Yeah. And something Rob and I have been talking about on our show on Fridays. It's because you think the labor market's strong. 2, the savings rate is high. And then 3, to your point, a lot of people these last 2 years have scaled back their lifestyle. If it's just somebody that hasn't moved and now is just working from home and the expenses that saves versus commuting and all that, or maybe the person that moved from Santa Clara to some suburb of Dallas where they're able to eat the same home for half the price. It's been fast.
Half the price and a much lower. And if they moved during 2020 or 2021, at record low interest rates, so payments that are considerably lower. So yeah, I think that consumer has definitely put, I think their balance sheets are strong. I think they've, people have saved. And yeah, I think the consumer, until you see movement on jobs, and that may be coming, I don't, depending on how, I'm not smart enough to know if they're going to land, how soft of a landing this will be. But, if you start to see job losses, I think you'll start to see some obviously some more weakness in the consumer. But right now I was on an airplane over the weekend. I mean, it was booked solid. Newark Airport was, packed solid. I mean, people appear to be traveling. Restaurants are, I think consumers are pretty strong right now. And there's probably a lot of pent up demand from not being able to do a heck of a lot for the last couple of years. Depending on where you live, things have been pretty restrictive. So,
yeah, record post-pandemic travel stats throughout July. To your point, I think there's just been a lot of different economic indicators that have showed that people are kind of getting out and about. Yep. This summer. And great point you made. I mean, I talked about, people moving, from higher priced areas to lower priced areas. But to your point, a lot of those people are going from, 3.5%, 4% rate that they had before to 2.25%, 2.5%, and going from Santa Clara to somewhere in Texas. Yeah. So interesting. And then as far as the supply issue goes further on down the pike, got some not as positive news this week on housing starts. That is defined, to simplify it, when a shovel goes in the ground to start the construction of a house came in at a 9-month low last month. If you look at housing starts year over year, though, single family housing starts in June were down almost 16% from June of 2021, 1 year earlier. So that to me was kind of the disturbing piece. Now, housing starts on units of 5 plus units was up like 15%. So, and that's largely by rents are up as well. People are trying to build more affordable housing units. And there's no demand, or there's no shortage of demand on the landlord side because landlords are doing all right now.
Yep. Now it's it was definitely a concerning number. It'll be, rents right now it appears are moving upward. They tend to, from what I've read and seen, they lag the housing values moving up a bit. So, if we do start to see any sort of mediation or, declines on the values, it'd be interesting to see what happens with rents and what happens with the, with that multifamily sector. Obviously, home building and real estate are such a huge part of the economy. You don't like to see numbers like that out there, but because it can affect so many different parts of the economy. When people aren't building homes and your trades and all kinds of other people are affected besides just the builder. But it'll be interesting to see if that's a sustained trend or if that was kind of a 1 month blip on a number, due to maybe interest rates or something else. So
yeah, it was another interesting part in the housing starts report. I think it's 6 different regions that they track, Northeast. The Midwest was up year over year. The other 5 in terms of, new housing construction. So new housing construction in June of this year in the Midwest higher than it was a year ago, despite nationally the number being down almost 16%. The other 5 regions all down. So again, going back to pandemic related migration trends as in housing. Something else I think you're starting to see on the new build side is more people that are looking to build a home, looking to do it in the center of the country statistically.
Right. Yeah. Now I think it's cheaper and probably more affordable, maybe more land available to be able to build, as opposed to someplace in the Northeast or, in the, in South. So, yeah, that was very interesting. And, maybe, there might just be, like you said, people moving with pandemic to some of those areas that maybe and doing some building there because, those are becoming more attractive, in that chase for affordability.
Yeah. And a great note in the chat from Brad Ketcher saying regional airlines have also helped the migration. It was harder to reach smaller cities 20 years ago. Now it is much easier to travel and allowing people to move anywhere for larger properties, son, work, etc. So yeah, great point, Brad. And yeah, we're watching it. We're watching housing migration really change in America as fueled and started by the pandemic. Something interesting to continue to keep an eye on. So what about this madness in China with all these? Have you been following that at all? They're like
a little bit,
building, and they're so behind on them. And the people that have pre-purchased these to be built units are essentially like, we're not paying you anymore. They're banding together, 20 some cities. Kind of a crazy story nationally.
It is. It's hard to figure out, sometimes what takes place there, and what trying to understand what's coming out of China is, what's accurate and what's controlled and what is actually taking place. But yeah, it's definitely going to be something to watch and see how that all plays out. But obviously is, I guess, probably the second largest economy in the world. They're obviously always something to keep an eye on.
Yeah, absolutely. So this is the last week of Mortgage Today. Got about 5 minutes left with Andrew McElroy from American Federal Mortgage Corp. Andrew, such a vast experience set in our industry. You've done so many different things, really strong operational compliance, tech background. Just interested to get your perspective right now. Obviously, lenders are focused right now on just cost cutting and really looking at their business and how they manufacture a loan and the cost to do so. And just, as we're here now in the heart of summer and what's been a slower than expected year, I would welcome your perspective on that topic from your seat.
I think right now it's probably you came out of 2 years of, basically, trying to keep your head above water, certainly two best years our company ever had. And I think that's probably the standard for, probably the case for most. I think now it's time to, you're focusing on, your operation, making sure the things that you've implemented are working efficiently, to make sure that your staffing is trained, and that you're prepared, because we know at some point you're gonna we'll start to move back the other direction, and it'll don't exactly know when, but it'll making sure that all those pieces of your technology, I mean, we try to be very tech focused and centered, to make sure that all those things are operating efficiently, and that you really are delivering the best best experience to the consumer, because every deal matters right now. Every referral partner matters. Every customer matters. Trying to make sure that we're really delivering every day for the consumer on their transaction, because it's a difficult market.
And just the compliance side of our industry right now, is anything there that has your focus, more specifically than other things that you're taking a look at in the compliance and regulatory side?
I think the thing that there's obviously always so much going on between fair lending and for us as a shop, we cybersecurity right now is something that every day I'm reading about, talking to our IT people about. That's been the area that we've spent a lot of focus on recently in this year, trying to really make sure that that our cybersecurity plans and what we do are what is needed in order to make sure that we're protecting ourselves and our consumers, the customers that we have. So it's a little bit of, it's kind of for people like me who are not technologically, necessarily in, detailed technological. It's a little bit of, it's a little scary, trying to understand what, what's out there, and what, the bad things that can happen, to your company when things go wrong there. So that's an area that we're spending a lot of time on and a lot of focus on, really trying to make sure that we're prepared.
Smart. We've seen a couple scary cases with varying outcomes for members of ours on the cybersecurity front over the course of the last several years, and try to find ways to use those instances to help educate the members. But I asked that question to a lot of co-hosts we have on this show, and nobody ever really says that, yet it's the one issue that it can take down your company overnight. There are like high rates.
Bad if it goes wrong. Yeah.
6 months of high rates, right?
Yeah.
Regulatory, tighter rate, CFP, we'll survive all that. Like, that's not going to impact,
change RESPA. I can work through that. That's easy for me. I'm not worried about that. This stuff that's the stuff that I worry about,
Yeah. Getting a note from someone saying, listen, we have all your customers' data and we want $1 million by Friday, or we're going to do all these heinous things with it. That, more terrifying than a 100 basis point rise in rate to a business.
Yes,
for sure.
Totally.
Andrew, really appreciate you joining me this week. This was great. Really enjoyed talking about the industry with you. This is definitely repeat invite appearance for you.
Thanks. It was a lot of fun. I appreciate it. It was good being with you.
Absolutely. And to our viewers and listeners, I want to thank you for taking 30 minutes out of your week with us. We're here live every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today on Zoom. You can go to mortgagecollaborative.com and register there once, and you're registered for all the episodes going forward. I know a lot of you watch on YouTube after the fact, but majority are listening on podcasts. So our podcast listeners that have made it all the way to the end of the episode, come join the live episode. Get to know our co-hosts up close and personal. also get a fair amount of interaction with the live audience on the show. So until next week, have a great rest of the week, everyone. Thanks again, Andrew.
Thank you.
We'll see you all next Tuesday. Take care.